$32 billion in 24-hour peak volume, 1.4 million users, an annualized revenue run rate crossing $1 billion. These metrics belong to Hyperliquid, a decentralized platform that currently holds 73 platforms built on general-purpose blockchains like Ethereum are structurally limited by the block times and gas costs of their host network. Automated market makers tried to solve this with liquidity pools, but they introduced high price slippage and execution delays. Professional traders require institutional-grade execution speeds, but they refuse to hand their private keys to a central custodian. Fulfilling both of these requirements simultaneously meant abandoning existing blockchain infrastructure and starting from absolute zero. Rather than building an app on someone else's network, Hyperliquid built its own Layer 1 blockchain exclusively optimized for trading. At its core is HyperBFT, a custom consensus mechanism designed to replace legacy synchronous networks. This algorithm delivers sub-second finality, averaging 0.2 seconds, with the capacity to process 200,000 transactions per second. Because the network is asynchronous, it operates continuously, rather than forcing validators to wait for discrete block windows like legacy blockchains. By controlling the entire sovereign stack, Hyperliquid eliminates the latency and congestion that cripple general-purpose networks. Operating natively on top of this consensus is Hypercore, a specialized engine that manages the exchange logic. Hypercore houses a central limit order book entirely on-chain, matching buy and sell orders exactly like a traditional financial exchange. Because the ledger is purpose-built, the transaction fee for placing or canceling an order is exactly zero. This is paired with HyperEVM, a smart contract layer that allows external developers to plug decentralized apps directly into this high-speed liquidity pool. By hard-coding matching logic into the consensus layer, the protocol makes external bridges and off-chain matching engines obsolete. A high-performance engine still needs capital. The challenge was securing deep liquidity to rival centralized institutions. The solution is the Hyperliquidity Provider, or HLP Vault, where users can deposit USDC capital. The HLP Vault functions as an automated market maker, deploying users' capital across the platform's order book. Traders receive deep liquidity with minimal slippage, while depositors earn yield from the spread and liquidation fees. By democratizing the market-making process, Hyperliquid bootstrapped its own liquidity without the need for venture capital firms. The final component of the system is the Hype token and its role in capturing protocol value. This diagram shows the core tokenomic rule. 97% of all protocol trading fees are directed straight into the assistance fund. This fund then executes market buybacks of the Hype token, permanently removing them from circulation. Higher trading volume generates more fees, which fuels more buybacks, decreasing the total token supply as activity grows. This mechanism directly aligns the platform's annualized revenue with the structural supply of its native token. Looking at the macro perspective, this architecture represents a shift in the industry. The protocol's growth is empirical proof that the trade-off between institutional performance and self-custody is no longer a technical requirement. Traders no longer have to surrender the custody of their assets to achieve institutional-grade speed and execution. Hyperliquid has evolved from a decentralized exchange into a financial engine capable of supporting the scale and speed of global finance on-chain.